Hey everyone, it's Konrad Bobilak here, CEO of Investors Prime Real Estate and a best-selling international author of Australian Real Estate Investing Made Simple. Welcome to today's video. It's going to be a very interesting video because honestly, I wasn't planning to do this video at all. And because there's a saying, a little bit of information is always dangerous. And the reason I'm doing this video for my YouTube channel audiences is because I've actually been introducing people to this information for the last 12 years during my live events. And I don't talk about it anywhere outside of that because in order to make this work, there's a lot of other things you need to unpack in the world of finance to appreciate the power of trust and how to use trust correctly. I've seen a lot of investors try to implement this strategy correctly, and honestly, the biggest challenge they have is they lack the team. They don't have a good accountant or a good mortgage strategist or a broker or a banker that actually understand how to implement what I'm about to teach you. And this is why I was hesitant to introduce this topic on my YouTube channel. Having said that, it's actually a very interesting topic in its own right because it allowed me to make millions of dollars in real estate investing and many clients because otherwise it would have been maxed out a long time ago. So what I want to do today is talk about how to harness virtually unlimited borrowing capacity by the use of trust. So welcome to today's video. Grab a drink or a coffee, sit back and relax and enjoy the content. Before we get started, I want to just do a bit of a disclaimer. This information is purely for educational purposes only. I'm not giving you any financial advice, and I don't recommend whether you use trusts or not. You've got to speak to an independent qualified financial advisor, an accountant, or a financial planner. Having said that, this has been a very lucrative strategy that has been successfully used for the last 20 years by some of the richest people in Australia. In fact, if you look at the politicians in Australia, business people, entrepreneurs, CEOs, doctors, lawyers, a lot of them don't actually own any assets in their personal name. Everything they own is in trust, and they control assets, not own assets. The biggest difference between the rich and the poor, and there's many differences, but one of the biggest differences is that the poor are obsessed with paying stuff off and owning assets in their own personal name. And whilst that has some benefits to it, the biggest danger of that is that you can get sued as an individual and lose everything that you have, including the shirt off your back. Rich people tend to control assets through trusts and entities rather than own assets outright for tax minimization, for litigation purposes, for different reasons. One of the biggest reasons, though, is for borrowing capacity, because owning assets in the trust and accumulating properties via trust and corporate trustees has a very different impact compared to borrowing money as an individual. And this is something that I'm going to unpack today in quite a bit of detail. So I hope you enjoy the video. Before we get started, I just want to cover just a bit of my background and why you should listen to me. I started off doing a 4-year business degree at Monash University, which was a complete waste of time. I ended up just spending all my time at the tavern, drinking beer and playing pool. Nearly did an MBA, more bad advice, but I thought I'd actually get out in the real world and start making some money. But I do have a financial planning background. I started off working for Australian Unity Funds Management in South Melbourne when I finished my degree. So I was actually working in financial planning, and Australian Unity Funds Management is a great company to work for. But majority of my background, with the exception of the last 15 years, has been in banking and finance. I used to be a mortgage broker, and I was also in commercial lending. And then at the end of my career, I ended up working for National Bank of Australia for a subsidiary called Medfin, where I was doing commercial lending, asset finance, as well as residential lending, but mainly commercial lending. And that's where I learned majority of the information. And this is where a lot of the stuff that I've put in my finance book ended up there, just learning and seeing what the rich people do and how they're structured. You see, if you got a bunch of rich people that have never met each other and they're very successful and they all have the identical structure, then this has to be something to it, right? As they saying goes, success leaves clues. So most of the stuff that I teach people, I haven't actually created any of this methodology myself. It was just things that I picked up from looking after high net worth individuals while working in private banking. Obviously, I'm a real estate agent also, and as well as I've got a mortgage broking degree. The most important thing about myself, guys, is that I'm a property investor here in Melbourne. And I've been investing now for a long time. I've been obsessed with property for well over 30 years. I've seen 4 property cycles. So I've been around the block many times. I've seen the ups and downs of the property market. So everything that I'm sharing with you is real information. I'm not an academic or someone that did something 20 years ago. I'm investing every day. I'm refinancing, buying properties. I'm going through a lot of the same things you're going through. And the majority of my assets, in fact, I would say 99% of my assets are in trusts. I don't actually own anything in my personal name as an individual, including cars. Everything's in trust. And there's a reason why I do that. And there is a reason why I hold assets in trust, not in my personal name. Now, the scope of that is beyond this YouTube video, but I do want to show you one aspect of the advantages of borrowing through trust and how it can impact your ability to build a large wealth and secure a large property portfolio that eventually has the ability to replace your income. By the way, before we get started, I just want to do a bit of a plug for my books, and I want to thank you guys once again for buying my books. My books have gone #1 bestseller multiple times on various platforms, including Amazon, which is the biggest. So my finance book and real estate book have been #1 and 2 many times in various categories. I really want to thank you guys for buying my books. If you want to get a copy of my real estate investing book, just jump onto realestateMadeSimple.com.au or Amazon, any good bookshop, or probably get a secondhand copy on eBay for $20. Save the trees. If you want to get a copy of my finance book, which I'm updating at the moment, and I'm actually writing a new section on trusts, because that book is a little bit old, but still has 90%, things that are relevant today, including how to smash your mortgage in record time. But I will be releasing a new version in 26, hopefully in 26, hopefully early in 26. I've actually been writing the updated version for this book for 2 years, and I'm nearly at the end of it. But it's funny because every time I complete it, legislation changes and things change in finance, and I keep going back to the previous chapters and fixing them up. But anyway, if you want to get a copy, jump onto bookonfinance.com.au. Enough of that shameless plug. Now, the first rule of investing, and I'm a big fan of Warren Buffett, I'm a big fan of shares. I also trade shares and options and crypto, but I won't talk about it on this channel. The first rule of investing from the most successful investor of all time, which is Warren Buffett, who owned Berkshire Hathaway, which has returned an average of something like 20% since 1970s. I mean, it is completely intimidating to fund managers. Rule #1 of making money: do not lose money. Rule #2, see rule #1. Now, people laugh at that and they kind of think it's a bit, whether it's cynical or whether it's a bit, it could be misleading, or maybe it's a generalization. It actually is not, because the #1 thing you have to look at when you're investing is asset protection. Because if you lose money, especially now in the stock market, you can lose positions. I've lost many positions in options, futures, by holding the wrong stock. But it hasn't wiped me out because my exposure was very limited. But if you lose money in real estate, if you lose $1 million or $2 million, you might not recover, or it might take you decades to get back just to zero. And that's why asset protection is so important when it comes to structuring your property portfolio. You never want to risk your house. You never want to risk what you have. One of my favorite movies when I was growing up as a kid was Willy Wonka and the Chocolate Factory. And my favorite moment in the movie is when Charlie finally finds the gold ticket, which, with all the odds against doing that, obviously. But this is what I felt like when I was working for Medfin, and I found out that you can actually tap into virtually unlimited borrowing capacity as long as you buy the properties in a trust through business banking, and as long as there's a letter from an accountant saying that the property is self-sufficient. To me, that moment was a complete game changer in my mind, because I just realized then, oh my God, I can just, as long as I can come up with a 20% deposit or 15% deposit and closing costs, I can just scale up my property investing portfolio to the next level. This was the biggest fundamental shift in my personal journey into wealth creation in property investing. This changed everything. And at the time, I think I was maxed out with 5 or 6 properties, and this just took me to the next level so quickly. The thing is, guys, a lot of people actually know this, but they don't understand how to implement it. I'm going to talk about that at the end. But really, this was a game changer. Now, I want you to, as I unpack this topic, I want you to ask yourself these questions. #1 is, do you now understand, at the end of this YouTube video, do you understand the benefits of buying investment properties, residential properties in trust and corporate trustees, and what implications that has on your borrowing capacity. Number two, when did you learn this information for the first time? So if this is the first time you're learning about it, great. Thank you. And I feel privileged for sharing the information with you. The thing is, it's been around for about 20, 25 years now. This is not new. Number three, where would you be today if you learned this information 20 years ago? What would your property portfolio look like today? How many more properties could you have secured if you knew this stuff 20 years ago? Now, I've been teaching this for 12 years in my live events. So if you learned this information 12 years ago and went to my 2-day event, paid $47 for a ticket, got a copy of my book, and you were exposed to this information, not only were you exposed to this information in extreme detail, much more detail than what I'm covering today in this quick video, but also I'll give you the whole team of people that do this all day long for their clients, meaning the mortgage brokers, the accountants, and the lawyers. Where would you be today 12 years ago if you started buying properties and tapping into virtually unlimited borrowing potential? And also ask yourself this question: if this costs you a lot of money and opportunity cost and time, what else is it that you don't know that's been holding you back? Because there's a lot of things that people don't know that they don't even know could be perfect for them as a strategy, but they never do it because they're not aware that it ever exists, and it could be perfect for you. Now, what are the advantages of buying investment properties in individual names versus trust? Now, this is so lucrative, by the way. Macquarie Bank just recently pulled the pin on the retail section of lending money via trust and corporate trustees. Now, a lot of people came out and said Macquarie's not lending in trusts anymore. That's not true. If you're a high net worth individual and you're dealing with Macquarie, you can still get lending in trust and corporate trustees. It's just the retail division, which is basically the division that deals with the general public, has shut down that area. Well, number one is because they've got too many clients that are maxed out borrowing, beyond their means. Number two, they wanted to slow down investors coming on their books, and the easiest thing to do is look at the most hardest loans that you're processing that require the majority of work, which is loans through trust and corporate trustees. So it's not something where people have, because a lot of videos popped up, and I've got mates that work for Macquarie, and they tell me, mate, nothing's changed, we can still do it. But a lot of these so-called experts and gurus popped out and said, this is the end of trust lending as we know it, and it's going to change everything. No, it hasn't. Okay, you can still go to Macquarie, if you're a high net worth individuals, and you can still borrow money in trust and corporate trustees. Now, first of all, what is a trust? A trust is a separate legal entity that can hold an asset. And when you structure a trust, which is really an entity that can hold an asset on behalf of someone, ideally, you don't want to be the trustee as an individual. You want to have a corporate trustee, which is a company. I usually set up the company as myself and my wife as directors. We have 120 shares because 120 is the only number divisible by 2, 3, 4, 5, and 6. So you can split up shares later on if you want to. And then you have a corporate trustee, which is the trustee for a trust. The trust holds the asset. The corporate trustee, with the directors being myself and my wife, we make the decisions about what happens to the assets. And that's all it is. So you're just separating the ownership of the asset from yourself to a trust. The trust has a vesting date of 80 years in Australia, so it lasts for 80 years. Then later on, I won't talk about what happens after that because it's too much for this YouTube video. But basically, there's a lot of tax implications. You can't negatively gear efficiently in the trust. You don't lose negative gearing benefits. They just don't get offset against your personal individual income. So if you're working as an electrician and you're on 150 grand a year, you can't offset the losses against your personal income as an electrician. You can only offset the losses of the property, the losses being depreciation on the building, fixtures and fittings, and all expenses, and including interest repayments against the rental income of the property. The remaining negative gearing benefits get quarantined inside the trust, and they keep rolling over and compounding until the trust starts distributing positive income, and then you can start claiming taxes against that income. I won't get into tax because I'm not qualified to talk about tax at all, and I don't want to touch tax. I have accountants do all this for me, but I can talk to you about the structuring part of it because I am qualified to do that. So if you're buying 3 investment properties, you would actually set up 3 separate entities. You would set up 3 companies, you would incorporate 3 companies and set up 3 separate trusts. a lot of accountants will tell you to buy 3 properties in the trust to save money. Now, the cost of this is around 3.5 grand. That includes incorporating the company, the trust, and accounting advice, right? Some do it cheaper. It's around $3,500, right? And generally speaking, if the accountant tells you to buy 3 properties under one trust, run away from that accountant because he has no idea about lending. And the biggest challenge in the industry is that everyone has their own little bubble and they don't understand what everyone else does. So I'm the accountant, I'm going to minimize your taxes. I'm the financial planner, I'm going to maximize your investment strategy and diversification. I'm the lawyer, I'm going to focus on contract law. Everyone operates, I'm the broker or the mortgage strategist, I'm going to talk about the lending. Everyone operates in their own little bubble, and people don't have appreciation for other areas. The reason you never buy multiple properties in one trust is because when you do something with one, you've got to value the others at the same time. And there could be scenarios where one of the properties goes down in value and you won't be able to get equity out of the other properties because the LVR has to stay consistent against 3 assets. And also, whenever you do one thing to one, you've got to value the other properties as well. So you want to set up a separate entity per property. So one structure, one investment property. And this is what it looks like. Now, I teach this in my book, and I'm not going to go through it in detail, but I'm going to give you a bit of a summary. So you've got your PPR, which is your primary place of residence, which is bad debt. It's non-tax deductible debt. And what you want to do in this game is accumulate a bunch of blue properties, which is your good debt, which is your tax deductible debt. Now, the thing is this, you want to set up an offset facility against your PPR, and you want to park all your rentals from your investment properties against your offset facilities against your house. Your salary and direct crediting and wages go also into your offset account. The key is these offset accounts have different BSB account numbers because you don't want to cross-pollinate your private individual expenses, going for a coffee and buying pizzas and putting petrol in your car, with your property expenses. So each property has one offset account, and then basically what happens is you have your rentals go into these offset accounts. They're offsetting your bad debt, which is your home loan. And then on the first of each month, which is what I do with my mortgages, the direct debit comes out of all these offset accounts to pay the mortgage for these properties. So let's say you live in Cheltenham, you've got an investment property in Mentone, Balmoral, and Brunswick, right? And each one of these should be with a different lender, by the way. You can have your house and first investment property with the same lender. After that, use 2 separate lenders. So your direct debit comes out on the first of each month out of these offset accounts, and this is how you smash your mortgage in record time. Now, I'm really skipping here because I want to get to the main part, which is trusts. If you're a plumber, electrician, you want to have your business structure completely separated from your property portfolio. You don't want any cross-pollination from your liability that exists in your work, if there is liability. Like if you're a dentist or a doctor or a surgeon, there's massive liability. If you're working in programming in Telstra as part of a large team, you're probably not going to get sued as an individual. So your risk profile is a lot lower than someone that's cutting people open all day long, and that's why the medical community pays massive amounts of indemnity insurance, and it's increasing all the time. It's one of the biggest deterrents from getting into the industry because people just sue people all day long. Melbourne and Sydney have become some of the litigious cities in the world, right up there with American cities like New York and LA. So you want to make sure that when you're building your property portfolio, you're buying everything in trust and separating the ownership of the assets between themselves and also your job, where majority of your liability actually lies. Now, there's a lot more to this topic, and if you come to my live event, I actually talk about scenarios with clients and other things, other measures you can use for asset protection. The biggest thing that you have to understand when it comes to the world of lending through trust is there's 2 lending areas in the bank. There is consumer lending and business lending. Now, in consumer lending, this is where APRA and all the regulators change all the rules. So how do you end up in consumer lending? It's simple. There's an individual name on the contract of sale. So if I was Konrad Bobilak buying a property in Cheltenham, my name goes on the contract of sale. I end up by default in consumer lending. And that's where all the rules are always changing and they're tightening up all the lending policies. And the reason they do that is because there's the psychology of the government in consumer lending is we don't trust you as a consumer. We think you're a danger to yourself. Okay, this is if you read between the lines of legislation. We're seeing too many investors buying too many investment properties. We're going to start reducing your ability to borrow money through either tightening lending policies, rejigging the credit scoring mechanism, changing algorithms. There's a lot of ways you can adjust, lending and reduce lending and borrowing capacity for individuals. Now, business banking is very different. Business banking is where the company is on a contract or a trustee of a corporate trustee of a trust. So let's say in Victoria, and every state has various rules, but in Victoria, only the company ends up on the contract of sale. In Queensland, for example, both the company and the trust end up on the contract of sale. So let's say Konrad Bobilak Pty Ltd is buying the property in Cheltenham. In business banking, the psychology behind the legislation is you're a director of a company. We're going to give you a lot of money, and if you go bankrupt, it's on you. You should know better. So that's kind of the two, I'm really generalizing here, but that's the two themes in legislation behind individuals borrowing money and companies borrowing money. Individuals like, we can't trust you, you're a danger to yourself. Companies are like, well, you're a director. If you go, we're going to give you a lot of money, but if you go bust, it's on you. And you want to be in business banking, not in consumer lending. Okay. So you want to go to the business banking section of each bank, which is a very small section of the bank, by the way. And these guys do trust lending all day long. That's all they do, because majority of commercial transactions are through trusts, not individual ownership. So consumer lending is very restrictive. Number one, you can only borrow 6-7 times your combined annual income. So if you're in 100 grand a year, you can borrow 600,000-700,000. That's it. You're maxed out. The reason for that is because the banks only take 30% of your annual income towards serviceability. So if you're on 100 grand after taxes and living expenses and insurance, there's only about 30 grand they use towards debt repayment, all debt repayments, including car loans, credit cards, everything else. And in terms of, so they shape 70% of your individual income towards serviceability, because you have to live, you have to have food, like food's nice, right? And rent. Now, if you're getting rental from property and you're getting, let's say, 50 grand a year, they'll only consider around 70% of the rent towards loan repayments, up to 80% with some lenders. Now, 80% is a lot, because when you consider that you take 30% of your income as an individual versus 80%, that's only 3-to-1 ratio. So the fuel for building your property portfolio, and this is a very important distinction, is not your job income, it's your rental income. Your rental income is nearly 3 times stronger in terms of serviceability dollar for dollar compared to your job income. That's why people on low incomes can buy 7 properties. I've got clients now that are buying 6-7 properties, and they've been around for 12 years now. And these are like average income earners. I'm not talking about my high net worth clients that are buying a property every 6 months. And people go, how are they getting 7 properties if I'm like double their income and I'm maxed out with 1 property? Well, this is one of the reasons I'm about to show you today. Because they're not buying these properties in their own personal name. They might buy the first 2 properties or the first property in their personal name, and after that, everything in trust and corporate trustees. Now, to further compact the borrowing capacity and restrict borrowing capacity in consumer lending, the banks will lower the interest rate by 2 or 3%, which is called the benchmark rate, and convert your interest-only repayments to principal and interest repayments, which increases your monthly repayments, which further reduces your borrowing capacity. That's why you can only borrow 6 or 7 times your combined annual income when it comes to investment properties. That's why the average Australian on 100 grand, we maxed out with 1 investment property. And that's why the average person doesn't know, well, how do I get to 10 properties? Or how do I get to 5 properties? Well, you don't get there by accident, guys. You get there by extreme planning and knowing exactly what you do and working with the right people. So business banking allows you to exclude self-sufficient investment properties from the serviceability equation. This is my golden ticket moment when I found this out. This is when I felt like Charlie. I said, you got to be kidding me. So as long as your property is cash flow positive, and it distributes positive income, which means you've put a large deposit in there, or you've bought a property with positive income, or it could be a dual occupancy property. Whatever the reason is, it's irrelevant. So if you've got a property where it costs you 50 grand, let's say you got $1 million property and your expenses are 50,000 per year, all inclusive, and I'm really simplifying just for today. So expenses include interest repayments, council rates, land tax, everything. And your property is getting an income of 60,000 per year, then it's cash flow positive by $10,000. Now, all you got to do is get a letter from an accountant that understands this, which is not every accounting group out there, saying the property is self-sufficient, because really you can argue that if you were hit by a bus tomorrow, knock on wood, that property doesn't need you as an individual to contribute anything to the property. You can just self-sustain itself because the rental income covers all the expenses and the property distributes income at the end of the year. It doesn't need you to contribute money to the property to sustain the property. Okay. So the argument is you're no longer needed in that property as a person, keep propping it up with income. Okay. And so most of the time, if you buy a good property in Melbourne with a 4.5% rental yield, if you put a 20% deposit in or 25, it's pretty much going to turn that property from cash flow neutral to cash flow positive, especially if you bought a few years ago when rentals went up 20-30% in Melbourne in key suburbs. And I've done a YouTube video showing you which areas they were. So this is the key moment. This is my golden ticket moment when I heard this, because I said, you have to be kidding me. And they said, oh no. And I said, how long has this been around for? And there's like, what year is it? It's like, this is like decades. So this is not new, guys. This is not something that just came in the market yesterday. This has been around for decades inside banks. So the key is you got a letter from the accountant saying the investment property that you're purchasing inside the trust, and there's a corporate trustee, the property is self-sufficient, therefore it can be exempt from the serviceability equation. That's the game changer. So what it means is you can continue to just buy property after property as long as you can come up with a deposit and closing costs, and that property will be exempt from the serviceability criteria. That is like crazy. That's like giving you a printing press for money if you're smart. I mean, this completely changed everything that I do, and my whole approach to investing in property. Now, the reason for that is, and I'm just going to step back a little bit. So if you buy a property in Melbourne and under individual name, the reality is, let's say for $1 million, I'm just using $1 million because it's a nice number. Stamp duty is 55,000, legal fees 3.5, so you're spending 1,058,500, right? The bank's calculations are the same, okay? Individual versus what the banks calculate. Now, let's say your rental's $850 a week, which is what we're getting on $1 million properties all day long. So you're getting 44,200 per annum. You keep 100% of the rental. The mortgage expenses are 50,000. Interest only 5%, which is 4,166.67 per month, and 1% in expenses. So your expenses are 60 grand. You're getting 44,200 as a rental income. So your loss is 15,800. Now, if you're buying as an individual, you probably get 15 grand back from the ATO, and it's cash flow neutral, right? That's called negative gearing. The banks calculate that very differently, because what they do is they shave 80%. They only consider 80% of the rental, so they shave 20% of the rental. So they reduce the 44,200 to 35,360 per annum. Then even though you're paying 5% interest only on your mortgage, which is $4,166.67 per month, they change that. They had 3%, which is 8% and they change it into principal and interest, which is $7,337.65 per month, or $88,051.50 per annum, plus 10%, or 1%, I should say, which is $10,000 in expenses. So your net loss in this example is $62,691. It's a huge difference between how the banks see the transaction, how you see the transaction. Now, this is the reality of buying a property in a corporate trustee in a trust with an accountant's letter. So you end up in business banking. You set up a corporate trustee with a trust. You're the director. If you've got a partner, she's a director or he is a director as well. You're both appointers, and that's a corporate trustee. The company doesn't trade. It holds just purely is a trustee for the trust. The trust holds the asset. Same reality as before. The property loses 15,800. So you would need to contribute 15,800 to this property every year. And as the rental goes up, that number diminishes, gets smaller and smaller, right? So one way you can make it cash flow positive is just have an offset account and chuck in 20 grand in there, or chuck in enough money against the property to reduce the repayment so it's cash flow neutral positive. Now, because it's in a trust and you get a letter from the accountant exempting it from serviceability, the banks see that as zero, which is like a game changer, okay? So let me give you an example of a couple on 300,000 combined annual income with $1.5 million financial pre-approval buying investment property, individual names versus trust. So you got a couple, they're on 300 grand, right? They've got a $1.5 million pre-approval. They buy the first investment property. They don't want to spend the maximum. So they say, we're going to buy a 750 property. They buy 750,000 property. Their borrowing capacity is 1.5 million. The second investment property, they come back to the same lender, let's say it's CBA, the Which Bank, and they also buy another 750 property. But by the time they buy the second property, their borrowing capacity is only 750 because the total is 1.5 million. Then on the third property, they are maxed out completely. And the bank says, computer says no, right? Because they're buying the properties in individual name. So every time they buy one, diminishes their borrowing capacity. Now, what would happen if that person bought that property in a trust on a corporate trustee? So they buy the first property for 750. Their borrowing capacity is 1.5 million, but they put a 20% deposit in there, or 25, and they get a letter from the accountant saying that the property is self-sufficient, and he gets exempt from the borrowing capacity. They come back for the second property. They buy another 750 property. The borrowing capacity is still 1.5 because he gets exempt from the serviceability. They buy the third property. The borrowing capacity is still 1.5 because they get a letter from the accountant saying the property is self-sufficient and exempt from serviceability. Fourth property, 750, just keeps going. The limitation is the amount of deposit they can come up with from properties, because these properties have to be cash flow positive in terms of distributing income in the financial year. Now, most accountants will do this after doing the tax returns for the first time with them, so they can see that it's cash flow positive. A lot of accountants want 2 years. I know accountants that will do 6 months, and a lot of accountants will do 12 months, just depending on your structure, whether you're a business owner, who you are, your asset position. So in terms of the difference is huge. The difference between the two is that in scenario one, the couple on 300,000 with a $1.5 million borrowing capacity is maxed out with 2 properties, and that's it, which is majority of Australians. In scenario number 2, because they're buying through corporate trustees and trusts, every time they buy a property, the accountant provides a letter to the lender saying the property is self-sufficient and their borrowing capacity is left intact. They can keep scaling up their property portfolio as far as they want, with the only limitation is time and the ability to come up with enough cash flow to either make the property cash flow positive or to find cash flow positive properties. I mean, it doesn't need to be blue chip property in Melbourne. You can go and get properties on Airbnb. You can get properties, by the way, they heavily discount Airbnb now in lending, but you can get properties with multiple bedrooms or dual occupancy, or granny flats at the back. Like, there's so many different cash flow positive scenarios. It doesn't matter how it's manufactured, it just matters that the property at the end of the year, financial year, is self-sufficient. So that means that the rental income covers all expenses and the trust has to distribute positive income to the beneficiaries. That's when the accountant can do the letter for you. And that's it, guys. It is insanely good. Now, I am just focusing on one aspect of this. In my 2-day event, I unpack this in extreme detail. But the essence of it is what I've just mentioned to you. And this is what really took me to the next level with my property portfolio. And a lot of our clients, there is no chance they could have scaled up to 6, 7, 8 properties without using trusts. In their individual names, they would have been trapped in the race just like all the other Australians. That's why 71.6% of Australians own one investment property. Only 0.9% of Australians own more than 6 properties. And one of the reasons, number one, is psychology and mindset. Number 2 is having access to specialists and structuring their property portfolio correctly. So if there is a secret to wealth creation, which there really isn't secrets, guys, there's no conspiracy out there where people meet somewhere in a secret room exchanging information. All this stuff has been available for decades. Okay, you just people that don't know this stuff. This is not new. This has been around since the 90s. Macquarie's been doing it for decades. All the private banking sectors know this. It's been around for a long, long time. But for you, it could be relatively new. Now, a lot of my clients take on the balance approach because the thing is this. Some of you want to get negative gearing benefits. Some of you don't want to buy everything in trust because you're paying a lot of tax. And I understand it. I understand the frustration with paying tax. Listen, I've cut checks for hundreds of thousands of dollars over the years to the ATO, and they're very painful. I mean, I remember I wrote a check, we can buy a Ferrari with that check, and I was just writing a check to the ATO going, I'm just giving away a brand new Ferrari. But I don't complain. It's a great country, and I'm very grateful for my lifestyle. So it's all good. I actually don't mind paying tax. as long as my money ends up looking after Australians and building infrastructure, schools, and transport, and not getting wasted. So the balance scenario is home ownership versus investing, because a lot of people ask me, this is a really important question, and I spend a lot of time on this during my 2-day events. Should I rent and buy investment properties, or rent where I want to live and buy investment properties to make money, which is rent vesting, or should I buy my house first, my PPR, private place of residence, and then invest? And then also, which one should I buy in my individual name? Which one should I buy in the trust? See, with my PPR, I've got it in the trust. I don't have anything in my personal name. Now, there's benefits of having a PPR in your personal name because it's capital gain tax exempt, and there's other tax implications as well around land tax. And I'm not going to get into the tax in this YouTube video because, quite frankly, I'm not qualified as a tax specialist. I'm not an accountant. But I want to just unpack this a little bit further. Renting your PPR, living where you want to live, and buying your first investment property in your personal name, and then other properties in trust. So a lot of my clients, what they do is they rent, they buy the first property in their personal name. It could be even a rental property that they rent out somewhere to another person. You don't have to live in the property. So they could be renting their PPR and then buying, say, 3 investment properties in corporate trustees and trusts, which is this example here. The benefit of that is that you can scale up your property portfolio very quickly. You can buy lots of properties. The only limitation is your ability to source cash flow positive properties or manufacture cash flow positive property with the right deposit. The negative part is you're not getting any negative gearing benefits because your primary place of residence cannot be negative gear. So you're paying full tax, and your investment properties are in trust, so you're not offsetting loss against your income. The second option is, for some of my clients, is where they buy their primary place of residence in their personal name, then they buy their first investment property in their personal name, so they claim negative gearing. So let's say you're on 100 grand, you're working for Telstra, right? You're paying 30 grand in tax. I'm really simplifying this, right? Don't email me with what you're paying on 100 grand. I don't care because I don't want to jump on the state revenue office calculator or the ATO calculator for and work it out. I should say ATO, not state revenue office. So, by buying a property for 750, you might get rid of 15, 18,000 of your 30 grand tax bill. But then you're maxed out with your first property. So then you buy every other investment property in a trust. So second investment property, third and fourth, all buying separate trust and corporate trustees. So the balance investing approach is buying a PPR in your personal name, followed by acquiring every investment property in a trust and corporate trustee. Number 4 is buying a PPR in a trust and corporate trustee, followed by every subsequent investment property in separate trust. So you could also buy your property in your personal name, live there, and then just buy everything in trust. The ultimate level is what I do, is I buy everything in trust, including my family property, because I wanted to scale up as fast as I could. And quite frankly, I didn't care about negative gearing benefits. So I bought everything in trust from pretty much day one. And that was my strategy moving forwards, because for me, while it was nice to get tax benefits, and you still get to offset losses against the trust rental income, but you can't offset the loss against your personal income. And there's other things you can do to minimize income tax. I was very conscious that I wanted to replace my income as soon as possible. So, and look, and by the way, there's no right or wrong here. Everyone has a unique case scenario. This is why you got to sit down with a professional and go through your scenario. But for me personally, this was the best strategy. It was just to accumulate as many properties as possible, replace my income, and then have options. For some of you, you're going to be happy buying the first couple of properties in your personal name. So it could be your house you're living in and your first investment property, even 2, and then buying everything in trust. It's very individualized. It depends on your tax scenario, your risk profile, your job that you're doing, even your age. Like, how long have you got to retire? If you got 10 years to retire, you want to be maximizing your ability to borrow money and buy properties. If you're 20 and you've got 35 years of working life ahead of you, well, you can take the conservative approach and buy the first few properties in your personal name, because then you don't care. You're still going to get to your 10 properties over time. But the biggest commonality between these examples is that trusts enable you to tap into virtually because it's virtually unlimited borrowing capacity as long as you can come up with either manufacturing the property into a cash flow positive scenario, i.e., coming up with a larger deposit, or buying properties that are cash flow positive from day one because of the nature of the property, and then just accumulating and getting that letter from the accountant that says that these are exempt from the serviceability criteria. If you do that correctly, guys, you can then transition from an employee by having positive trust distributions into a consulting company and then have that as income and you can keep borrowing money while you're retired. Otherwise, if you quit your job and you don't have this set up perfectly, the moment you quit your job, you can't borrow a cent in Australia when you're retired. Your borrowing capacity goes to zero. So you want to set up all these structures and understand all this before you're 65. It's very difficult to borrow money in Australia after 65 because every bank has life expectancy tables based on the year that you're born. So if you were born in a certain year and you're going to die statistically, in 25 years from now, and you're going for a 30-year mortgage, computer says no. Now they can't tell you, oh, Mr. Johnson, you're going to be dead in 25 years. There's no chance you're going to be paying off a 30-year mortgage. Can you imagine they said it to someone beyond current affairs, right? So they can't tell you're going to be dead in 25 years because statistically, you could die 5 years from then, or you can genetically, if you're superior or you got a good lifestyle, or you're just lucky, you can live for another 40 years, right? So life expectancy tables are just statistical probabilities based on data. It doesn't mean that it's a guaranteed result. But the reality is this, guys, because people don't think about this. If you stop working and you're retired and you have no income from your job, you can't borrow money apart from reverse mortgages. You can't borrow money in Australia. But if you set up a consulting company and then collect rental income from trust distributions and pay yourself a wage, you can retire. You can transition from an employee scenario to a professional property investor scenario and still pay yourself a wage and still keep borrowing money well beyond your retirement years. And that's how making that transition is so important. But also, you can't set this up when you retire. It's going to be set up 10 years before you retire to make sure the whole thing works perfectly. And remember, guys, the more you learn, the more you earn. So I hope you had some knowledge, some nuggets of wisdom that I've shared with you. I hope the penny dropped during this YouTube video. I hope you enjoy the content. My biggest advice to you guys is don't wait to buy real estate. Buy real estate and wait, because it's always very challenging to get a loan. And you never time the market perfectly. It's always going to be timing the market, not timing of the market's going to make you money. If you want to know what's happening in 2026, we're in December now, 25. Number one is watch a video that I did recently on the best undervalued suburbs that will boom in the next super cycle of 26. You can check out where I think which areas are the hotspots. And also, if you want to get into house and land estates, these are my top 10 best house and land estates to buy into in 25 and 26. Check out those two videos. And remember always, guys, be fearful when others are greedy, be greedy when others are fearful. Warren Buffett. So ask yourself the following questions. We're at the end of the YouTube video now. Number one, do you truly understand now the implications of buying investment properties in corporate trustees and trusts? If you don't, please play the video again. If you still want more information, come to my live event. This is like the most fundamental thing you can understand as a property investor, one of the top 10 things. Number two, now that you understand it, hopefully, think about how many properties you could have bought 10 years from 12 years ago when I did my first live event at Investors Prime Real Estate, when I was teaching this on stage. Imagine you learnt this 12 years ago, which is 2013. 12 was the first year. And you've bought 5 properties, 10 properties since then because you had enough equity, or you were just targeting the right properties in Melbourne or Sydney or anywhere else in Australia. What difference would it make in your life if you had those 10 properties today? Number 3, how much time have you lost not knowing this stuff? Because it's been available for decades. This is not something I created. I just took it. I was taught by NAB how to do this. And what else don't you know that's holding you back? Because ignorance is not bliss, guys. Money is made through knowledge. And remember, at the bottom of the markets, there's more transfer of wealth than any other time. And the money flows from the uneducated to the educated. Knowledge is power as long as it's implemented. If it's not implemented, it's nothing. It's just a waste of time. But think about all the other things you might not be aware of that could be perfect for you. They could make a substantial difference in your financial life to you and your family and your future generations, but you don't know that it's available to you. And the worst thing that could happen, guys, is, and I see this in my live events, I see people in my room that are 70, 65, and I just tell them, it's too late. We can't help you. You should have come to us in your 40s or 50s. You've missed the boat. You've retired. No one's going to give you any money. I don't know what to do. I can't help you. You know, that is the worst thing. Knowing you could have done something very easily when you were younger, but you just got up. And I understand life's busy. Kids, stress, work stress. Everyone's got challenges. Property investing is very passive. The worst thing you can get is to get to the end of your working career realizing you could have done so much better for your family and for your future and have an easier retirement rather than relying on the pension or government subsidies. So what's your next move, guys? What's your game plan for 2026? The minimum that I would recommend is definitely get a copy of my two books. And it doesn't need to be my books. There's so many good books out there in bookshops about property investing. Make sure the person you're learning from is qualified and not just some young 20-year-old kid. I'm seeing all these pop-up gurus and influencers on YouTube and Instagram and TikTok talking about property investing, and I look at them as like, you're 21. Do you even like have any investment properties? A lot of them look like they're still living at home with mum. Do you know what I mean? Like, have you're still at home. So make sure the person you're dealing with, number one, is qualified but through results, number one. Number two, if you're talking to someone about structures like this, make sure they've got the right diplomas behind them or the right job credentials, that they've done this. It's not just theory. A lot of these gurus are teaching theory. They have no idea what they're saying. They're just copying some other guru from another YouTube video. There's so many mistakes that I see in a lot of these presentations. I mean, I don't spend a lot of time watching this stuff. I randomly just in my feed, because I always watch a lot of Cotality, RP Data CoreLogic, which is Cotality now. A lot of these kind of real estate related streams. I just end up with these people in my stream, and I will listen to them. I just go, "You've never done anything like this. You're just making stuff up." So you got to make sure the person you're dealing with is qualified in the sense they got the results, they got their qualifications. Be careful with broke academics as well, because you can go too far to the extreme, end up with a broke academic that's achieved nothing. If you're interested in learning more, and I hope you are, number one is I'm doing my live events in 26 again. You can jump onto realestateFasttrack.com.au, check out my live events. We're going to do a bunch of them. These events are basically talking about all aspects of property investing, and how to build, structure, and automate a large property portfolio from scratch that can replace your income and leave you a legacy behind for your future generations. So if you're interested, feel free to get some tickets. They're only $47, and you get a hard copy of my book, Australian Real Estate Investing Made Simple. And I hope to meet you in person at my event. If you're ready just to jump the queue, and if you're serious about property investing, then I also encourage you to book in a free 60-minute strategy session with myself, and where we go through your situation on Zoom. And in 60 minutes time, I can identify where you are, where you want to be, and I'll give you really good feedback about how to fast track from point A to point B. We come up with an idea and a plan and an action plan. This is not hype. This is not to get you excited. I'll tell you exactly mathematically how much money you can borrow. I'll tell you what the outcome would be in 10 years' time, give or take. Now, you can always exceed that. There's no limit to your ambition, but I'm telling you mathematically, this is roughly what you can do from a serviceability perspective. And I'll do a whole plan with you. You can walk away, at least you know what your options are. It is free, it's priceless. Plus, you get the whole team of experts around you if you don't have them. Remember, if you fail to plan, you plan to fail. Don't leave it too long, guys, because lending is very bureaucratic. It takes a long time to get money. And the older you get, your options start to diminish, especially as you get closer and closer to retirement. So you want to start as young as possible. When I see, a lot of my clients are 20, 21, 22, and I think, Jesus, I wish I knew this stuff when I was 21, 22. I mean, I could have added another zero or two to my portfolio, but it took me decades to learn this stuff. A lot of people that I see waste time, and time is a resource that is always running out. Remember, you can always get more money, but you can't get more time. And one time runs out, that's it, you're stuck. So what this does is it just allows you to cut through all the noise and get a really concise plan of how many properties you can secure over 10 years and how you can replace your income. It's a 1 hour strategy. It's free. There's no strings attached, no upsell, no anything. It's just me and you on Zoom talking about your future. I also give you access to my accountant, my mortgage broker, anyone you need. If you don't have your own team, I can refer you to some of the best consultants in Melbourne. I've been in the financial service sector since I was 21, and I'm nearly 50 now. So, 28 years, you pick up a lot of context in the industry. I source properties, as you know, I'm a buyer's advocate and a property sourcing specialist. So you walk away with a team plus access to properties and the strategy as well. It's a step-by-step blueprint, guys. It's so simple to use. Now, there is a qualifying criteria. Melbourne's getting more and more expensive, and I'm finding it really challenging to source anything under 700,000. Majority of the stock that I'm sourcing now is 750 to 800 minimum, with the average townhouse being 1 million to 1.2. So as a single person, you have to be at least pre-approved for 700,000. So you have to be on that kind of 95, $100,000 income and have access to 112,000 in equity. Now, if you're a first home buyer, if you qualify for the 5% deposit scheme, no LMI, you just need 50 grand, I can help you. I've got plenty of stock up to 950. I have access to over 1,700 townhouses right now, and I work with 67 developers actively in Melbourne. And some of these developers do one project a year, some of them do 10, some of them do 600 builds a year. So I've got access to 1,700 plus properties right now, and I cherry pick the best ones for my clients. I'm not a developer myself. I don't have to push an area or make anything look better than it is. It is what it is, okay? So if you're a couple, you need to be on that kind of 120, 140 income plus about 112,000 equity, or you can be first home buyers. You need 50K and be pre-qualified to get a property up to 950. If you do qualify, just drop me an email, conrad@investorsprime.com.au, or scan the QR code, and I hope to meet you in person, either via Zoom or in my live event. That's it for me, guys. Thank you very much. I hope you enjoyed this video. I know I got a little bit technical here, so feel free to watch it again. If you have any questions, send me an email. If you want to book in a consultation, definitely also just email me directly. This is Konrad Bobilak, guys. Thank you very much, and I'll see you on the inside.